Hey, how are you traders? How are you? I hope everybody's okay. Everybody's fine. I'm sure everybody's doing well. And I'm sure you get me. You hear me clearly. The audio quality, I think, is good. So now let's get on with our sessions actually, and mainly is on advanced Elliott. And we're in the last session. So I've got a mood to do something. Blessings have come, and actually I'm doing something. So I'm presenting the last session on advanced Elliott wave course, the 12th session. So now before going to our session, I remind you the things at our homepage. This is our homepage, actually YouTube homepage. So when you visit this homepage, if you are using computer, we have buttons which are very active there. Those buttons, they are active, they are sensitive. So you can click any button and then it will take you direct to a particular area that you're supposed to go. So we have added this, which was not actually pleasant for a while, actually. Tick mill. We have added that button for a broker. Some conditions was changed, that's why the button was removed, but we have brought this back because those conditions are back again to tick mill broker. So now we still recommend tick mill broker again to those traders who want to trade. And also we have light forex as usual, as how we have been doing all the days. We recommend you to light forex broker. Now the difference between those two brokers is the initial capital, the starting capital. If you have a very minimal capital, that is 10 USD, or I can say below 100 USD. If you have less than 100 USD, you can start with light forex. But if you have 100 USD and above, you can start with tick mill. So that's why we're recommending those two brokers. They have good trading conditions. There are only differences on those initial capitals. So now let's go to the last session. That's the 12th session. Our today's session is the 12th session, and it is the 12 out of 12 now. It's the 12 of 12. It means the last one. So we are graduating today from what we call the advanced Elliott wave. We are going to complete a course and then we are graduating. So for anyone who was following those sessions from the introductory up to this one, so must celebrate. Yeah, you must celebrate yourself that you are in a final session. So now that's good. Then now our today's thing is from what we call the right look and what we call the wave principle tips. We have those called the tips of the wave principle, or tips of applying the wave principle profitably. So we'll start with what is the right look. I'll give those ideas of that, and then we can see market structures in terms of what we call the right look, and then we'll come to wave principles. The wave principles will be the last things. So now the right look. What is the right look? Now when we're talking about the right look, specifically we are concerned with those appearance of structures in the market when you are analyzing the market. When you are analyzing the market based on the wave principle, you must have a right look. And I think even on the price actions, you must have a right look. If you say that maybe I see triangle or I see zigzag, that zigzag must conform to what we call the appropriate illustration. We have this, we call it as appropriate. We have this, we call it as appropriate illustration. So each structure, maybe in the price action, each structure must conform to the appropriate illustration. So it is the same even in wave principle, whereby if you are maybe labeling a wave as an ABC, or you are labeling the 1, 2, 3, 4, so there is an appropriate structure that must be considered in order to name that particular move as 1, or to name it as ABC, or 1, 2, 3, 4, 5, or anything else. So we need to have what to call the appropriate illustration. So now, what is the appropriate illustration? I'm going to give pointers as time goes. So now, where the problem comes? The problem comes when traders start to force things. They start to force things. They need those things that they have in their mind to appear in the market. So when someone opens the charts, actually he or she goes there with his own or her own charts, with his or her own appearance of the market structure. So when a market structure maybe correlates slightly to what he or she think, or completely, the labeling will be in that way. So we say that in most cases it happens a trader wanted to see, always a trader see what he wanted to see. That's the case. A trader see what he wanted to see, what he or she want to see. That's the problem. Want to see. So when you see what you wanted to see, it's when you become wrong in the market. So usually you must see what is actually there. You must see what is actually taking place in the market. So if you see what actually is taking place in the market, it's what we call the right look. But if you see what you want to see, that will be the wrong look. That's what we call the wrong look. So we're supposed to have a right look. So now, how can you have that right look? How can you have right look, or how can you attain that ability to have a right look? So now, example, I will present a structure here. I will present a simple structure here, and then we will see what's the right look and what is the wrong look. So we can have a market structure of this type. This one, it goes up, maybe it goes down, it goes up again, it goes down in around. Maybe this one is too clear, showing the internal structures. So it goes up again. So now, when there is such kind of appearance, now market goes up. So when there is such kind of appearance, a trader may have his own perception from this structure, may have his own image on what he wants to see from this structure. So if he has his own image, actually the labeling will be in relation to what he actually wanted to see, instead of what is really happening at that particular place. So now, when you see such kind of such kind of appearance, or that market structure, you can have different types of labelings. So those different types of labeling can be true or can be wrong. So now, someone can label. I will go straight and show those things. So someone may label this move as this 1, 2, 3 corrected, goes on. So someone may label this as an A, this is B, then this is C. So this ABC, this is big A in higher degree. Then now this one will be something like a B now. Now in the same degree like that A now. In the same degree like that A, so this will be B, and finally this will be C. Now this is one structure that a trader may identify from this move. So this 1, 2, 3 things goes on, then we have the final move. So someone may identify this type of appearance. So now what happens after this C? Maybe someone may expect a correction or anything else. So you will find that market may correct as usual, and the trader may trade and make money. That's why, according to a book of Elliott Wave, Key to Market Behavior, there is a certain statement there that explains that you by using wave principle, you can make money even you are wrong. Even when you are wrong, you can make money. So when someone make such kind of counts, they can be correct or not correct, but based on what is going to happen next here after this C, you can find that the trader is making money even he or she was wrong. So now, is this count correct or incorrect? Is this count correct or incorrect? Anyone? I will count down. 5, 4, 3. Yes, 2 and 1. I'm sure everybody have got an answer. Here. If this is wrong or it's correct. So now, according to me, this count is wrong. It's incorrect. This count is incorrect. So now I'm giving you reasons why this count is incorrect. So now those reasons that I'm going to give you, those are the judgments that you have to make before labeling a certain move in the market. Those reasons must be your points of judgment when you want to label a structure of the market. So now the trader here will be wrong. Why will it be wrong? Because in an ABC structure, the first thing there, in an ABC structure, in most cases, wave B must retrace deep up to at least 50%. In most cases, in an ABC, wave B must retrace down, must go deeper, at least to 50% of the previous move. Then it goes on. So now you'll find that here, this wave B is too shallow. This wave B is too shallow. So being shallow, this will be one reason to why this is not an ABC. I'm sure you have got me. So now, if this is not an ABC, now we'll go to another idea of labeling. This another idea of labeling this will be the 1, 2, 3. Then I'll give you reasons why this is the 1, 2, 3, 4, 5. I'll give you a reason why this is the 1, 2, 3, 4, 5. So now a correct labeling here will be 1, 2, 3, 4, and finally 5 to the top. So this is the right look. Now the first one was a wrong look. Now this is the right look. Why this is the right look? This is the right look because in a 1, 2, 3, 4, 5, usually we expect the fourth wave not to enter the price territory of wave 1. When you find that a fourth wave ends just above, ends slightly above the first wave, this is clear that this is the 1, 2, 3, 4, 5. That's the first strong reason why this will be the 1, 2, 3, 4, 5. So now we have exception. Now we have exception, a special case, and this is in diagonals. We have those who call the diagonals. I'm sure you know what are the diagonals, and I already presented about diagonals. So the exception will be in diagonals, whereby the fourth wave may retrace and may enter into price territory of the fourth wave may enter into price territory of the first wave. That's a special case. But when you are labeling the 1, 2, 3, 4, 5, make sure you look at the level at which the fourth wave ends. It must end slightly above the fourth wave. So that's the first case. That's the first case on having a right look. That's the first case on having what to call a right look. I'm sure you have got the concept. So we'll have other forms of the right look. This is just a first form of the right look. So we'll have other things on what we call the right look. So other important things on what we call the right look they comes from the idea of extension. They comes from the idea of extension. Now I have explained this, but you can find in books. You can find those concepts in books. You can go and find Elliott wave books and read in detail those things. I'm giving you directions, just highlighting those key concepts, but you can go in books and then read in detail. So now things goes on whereby the right look also can people may misinterpret. People may enter into a wrong look when there is an extension. So now, how will you identify that there is an extension? How will you identify that there is an extension? So now a count may be something like this one, corrects, things goes on, it corrects, things goes on. So may go on and on, but I need to deal with just this appearance. I want just to deal with this appearance. So here we can also have our own understanding of this structure. We can have our own understanding of this structure. Someone may label this as 1, as usual. 1, maybe this is 2, 3, maybe 4, and finally this is 5. The 1, 2, 3, 4, 5. Yes, this is what someone see in a chart. That's the reality of what someone see in a chart. But now, what someone sees in a chart actually may be correct or not correct. That is, can be correct, can be right or not right. So now, if someone label this as a 1, 2, 3, 4, 5, actually, this 100% this will be wrong. This will be wrong count. So why this is a wrong count? You must refer to what to call the guidelines. We have those who call the rules and guidelines. Rules and guidelines. You have to refer when you are labeling. In order to have what to call a right look, you must keep in mind those we call the rules and guidelines. Rules and guidelines will guide you, will show you a correct count, and also may help you to understand possible, meaning that we call the possible point where the market may end. So now things goes like that. This count is not correct. Why it is not correct? Because usually the third wave cannot be the shortest. Do you see? The third wave cannot be the shortest of the first and the fifth. Between the first and the fifth wave plus the third wave, actually the third cannot be the shortest, but it can. The third wave can attain equality with anyone, the first or with the fifth. When it attains equality, it has an equal distance travel. When it has an equal distance travel, actually, there will be no problem. But if it is the shortest compared to the first and the fifth, something will be wrong there. So now, what is the right look? Now, what will be the right look if this one is wrong? So here is when we come to the idea of extension. I think I presented the idea of extension, so we apply it now in the right look. That's why I said these last 3 sessions in advanced Elliott web, they are very key. They are very important. So they are very important because we are looking at those things in reality. We are looking at those things in the reality of the market. So now, in the idea of extension, how are we going to count those waves? Now I'm going to clear those labelings. I'm going to clear my counts which were wrong now. So some people will label like this and then plan to trade a correction here. A person will get ready to trade a correction here. Then you will find that the price is not correcting. It's no longer correcting. It keeps on going. It keeps on going. So now this is because of the imperfect look. So the right look here will be 1. This will be 1. Then this will be 2. Now as long as the third wave is short compared to the next wave, so this will be 1 also. So now I can put brackets to differentiate degrees. I put brackets to differentiate degrees. So this is 1, 2 at a certain high degree. Then its lower degree has also got 1. Now I can put this way, has got 1. Then it will have 2. It will have 2. Then things goes on. This will next year will be 3 in that particular degree. So now this is 1, 2, then 1, 2, 3. So things goes on whereby we'll have 3, 4, 5. Now we'll have that 3, 4, 5. Now completion of this. Now we have the 4th. Then we have the 5th at the top. Now completion of those internal. The completion of those 1, 2, 3, 4, 5. The internal. It will be, now this will be completion. This will be completion of the higher degree third wave. The third wave there. A higher degree third wave will be completed by those 1, 2, 3, 4, 5 of the internal. After completion of this, if you know the perfect look, now you will expect a correction. After completion of this, now you will expect a correction. Now this correction will be in the 4th wave, then things goes on. This will be now the 4th at that particular degree, then the 5th at the same degree will be at the top. So this is what we call extension. So the imperfect look will count this as 3, 4, 5. Then we will expect for a big correction there. Then you will find that the market is no longer correcting. It keeps on going. It keeps on going because you were in a wrong look. So now this is simply just an extension. But sometimes you may go in detail. You may go deeper. You will find an extension within extension. So now how things play there, I just present very shortly here. In extension, within extension, you can find this type of structure. The market goes on. This is 1 as usual. Things goes on. It corrects. Then it goes on there. It came in down. Then it goes on. You see? Then this one. This one. You see? So things may go like this sometimes. Things may go like this. So in this situation also, a person may end up into imperfect look or the wrong look in this situation. So now, how are you going to do when you have this type of structure? What will be the right look? Because the wrong look will be something like 1, 2, 3, 4, 5 or anything else. I don't know the wrong look. I only know the right look now. So the wrong look, maybe you may have a wrong look. You may know how to count in your own way, but I'm going to count in a right way. Then if you had a different type of count, now you were in a wrong look. So you know your own wrong look, but I'm going to show you a right look. So now a right look will be something like, now 1 in that particular degree, then 2 in that particular degree. So this one, we're expecting this to be the third, but actually it had a short distance travel, and then other internal waves came in, other smaller waves just came in. So this will be, now this will be 1, now this will be 1 in that particular degree, then this will be 2. So now after this 2, we expect 3 there, we expect 3. But if you check on the idea of equality, this one compared to this, you can find that this one is short. You can find that this one is short, and also we're expecting this to be also something like this. I expect this also to be something like this one. It goes up, it goes up, it corrects, goes up again. So now something like this. So if you check this one, the first one is longer than this, which we're supposed to label it as the third, and also the next wave is also longer than this one. You see, the next wave is also longer than this one. So now labeling this as the third wave will be in a wrong direction. So think there will be something like, now 1 2, then instead of having 3, we will have 1 at another degree, lower degree. Then we will have 2 at another lower degree. Then we will have 3 at that degree. Then 4 at that particular degree. Then 5 at the same degree. Now, those numbers actually, they in cycle. Now, yes. So we have those things. The 1, 2, 3, 4, 5. Now, completion of this 5 will be in completion of the third wave. The third wave at this particular degree. Then after completion of this third wave, remember we had this one there, we had this one, so we had this 1 2, then 1 2. Now after completion of this will be just a third wave of this internal. So this will have the fourth. Now this will have the fourth wave now at that particular degree, the fourth wave, then will goes up with its own fifth wave. Now it will have its own fifth wave. So now I have not put those brackets at this degree, so we'll have this as the fourth wave, then the fifth to the top. Now completion of this fifth to the top, now completion of this fifth to the top will be a completion of the third wave at that particular higher degree. Now completion of the third wave at that particular higher degree. We had this degree there, we had this degree, this one had got the second wave, so it had extension that has got an extension also. So we will have the third there, fourth, fifth goes on. So now that's what we call the right look. So when you count differently, you are not in a right look. When you count differently, you are not in a right look. You are in a wrong look. That's all. So now the idea here will be there are variation. There are certain variations. There are certain variations that exist in the market. I'm talking those things as a principle or anything else, but there is variation in the market. It depends on which type of instrument are you trading. So you may trade stock by using the Web principle. You may trade the currencies, commodities, or anything else. So you'll find that when you deal with a particular type of instrument, you can identify specific characteristics of that particular instrument. So, example, we have said that maybe I said before, in a correction, if it is an ABC, let's say, if market was moving this way, then we have an ABC. We expect B to move at least to 50%, then things goes on. This was A, B, now C. So at least to 50%. But you'll find that maybe in commodities sometimes, because I'm dealing with them, metals. In metals, they don't exhibit the thing all the time. Sometimes they do something very different. So because I already know the characteristic of instrument that I'm trading in, so I can I can just alter those things. I will not be rigid as how things have been presented here. I will be flexible. Sometimes I see this, then I interpret in this way, things goes on like that. So you must be flexible and then know the instrument you are trading. You must be flexible and know the instrument that you are trading. That's very, very important. So now that's all about the issues on interpretation. So in the right look now, people really think like, oh, I have to work out, I have to work out deeper, interpret those waves in detail in order to get that to call a perfect look. In order to get that to call the right look. There's no such a thing to work deeper and deeper. Sometimes you can find that a market may illustrate or may demonstrate more than 2 right looks. Do you see? Sometimes you can have more than one, let's say, more than one right looks. So when you have more than one right looks, it's when you come to what we call the alternative. Now we have this. We call it as an alternative counts. We have this to call it as an alternative count. So sometimes it is acceptable in the wave principle. It is acceptable to have more than one count. So you'll find that we have the same type of move. In that type of move, you have maybe this as 1 or A. Then this can be 2 or B. This can be 3 or C. Do you see? Sometimes I'm sure if you are reading charts from experienced wave practitioners, you find that sometimes they label things like this. They label things like this because of the idea of alternative counts. Alternative counts. They have 2 right looks at the same time. But as market goes on, it will commit itself. It will commit itself to one type of count. Do you see? As market goes on, it commits itself to one type of count. But you're supposed to have alternative count in order to stay alert. Do you see? You stay alert. You stay attentible. You have attention. I don't know how to put this. So you will have attention. You will have attention to a nearly possible variation. Do you see? You will have attention to a nearly possible variation. So if this is 3rd, we expect the 4th, 5th up. But when you find that market don't go up, so your C count will be correct if the market now goes straight down, and your 3rd 1, 2, 3, 4 count will be now not a preferred count. Your preferred count will be the ABC. So that's what we call the alternative count. The alternative count. I'm sure you get me. Those things are too deep. Those things are too deep. People, they only teach to count 1, 2, 3, 4. They teach those things, but they don't go straight to things like this. Most of mentors, they don't go straight to things, to such kind of things. So after knowing this, the idea now will be, as you stay in the market, you can develop your own rules. Yes, mainly guidelines now. I want to say guidelines, not rules again. You will have your own additional guidelines. Do you see? You will develop your own guidelines as long as you know, you get familiarity with the instruments that you are dealing with. Now you will develop your own guidelines or additional guidelines. So now, example, one thing that I usually use. Now I have this idea: when the market is moving in upward direction, let's say, then it has corrected with an ABC down. It has corrected with an ABC down. So it may be clear now, it may be true that this is an ABC, but based on the idea of alternative count, this also can be 1, 2, 3. So it may correct to a certain level, then it goes on. So now the principle here to trade this, if my count is just an ABC, I don't have the 1, 2, 3 again. If my count it is just an ABC without having the 1, 2, 3, usually I trade this going up by putting my first target right at this area. If I have opened multiple positions, So I will expect some trades to take a profit right at this area because there is high probability for the market to hit this area. But if you will put your targets beyond this level, so sometimes your ABC count may be not correct, so the market may not reach those levels and turns down. So in order to increase the probability of having wins, the first target in the ABC should be at this wave B. So if it will be ranging, going on there and there, but there is high probability of this market to hit this level. That's why I put the first target at that area. I'm sure you have got me. So this is like my guideline. Do you see? This is like my guideline, something that I also apply. So now I'm through with the issues on the right look. I'm through with the idea on the right look. So I'm completing this last session, the final one, by looking on tips to apply when you are, tips to consider when you are applying the Weber principle. So actually, I remind you again, we have taken a very long journey, starting from the introductory up to this this last part. So if you have been with me throughout the whole journey, please put your comment there. Put anything actually. Write anything. You can just put even a full stop. You can put even a full stop to show that we wind up. We wind up. I need to know those people whom were going together with me. Those who were going together with me, I need to know them. So if you were with me from the beginning, just do anything there at the comment section. Ask a question, or like it, you share it, you do anything else, you put a full stop, you say this is enough, you say, oh, thank you, or anything else. That's what I want you to do. But if you didn't, you haven't watched all of the sessions, please go back and watch. Those things are relating, and I have arranged them based on relationship, how they relate, one session and another, how they relate, how they are difficult. You see? So as we go, example, those last 3 sessions, they are deep things. Last 3 sessions, they are deep things, including this. They are very deep things. Those are the reality of application of the Weber principle. It is not only knowing how to count those things, knowing market structures, those diagonals and other things, triangles. No. The real applicability of the Weber principle is knowing those 3 sessions, the last 3 sessions. So now let's go to tips. Now the tips, just I will mention them. Tips. There are a lot of them, but I will mention those most common. So when you are applying the Weber principle, the first tip to consider, you have to consider those who call the Elliott wave guidelines. You have to take in consideration, in order to use the Weber principle profitably, you have to consider guidelines. That's the first thing. When you are making those counts, in order to have those who call the right look and those who call the perfect counts, you must consider guidelines. And also, the second thing, you must consider those who call the rules, as usual. Rules and guidelines, all of them, they are playing together. Rules and guidelines, all of them must be considered. And also, when you need to apply the Weber principle profitably, that's another tip. When you want to apply the Weber principle profitably, you have to accept the analysis. Do you see? Accept the analysis. Accepting the analysis now, that's the third thing. Accepting the analysis. Accept the analysis. Now, accepting the analysis, it means you accept when you are wrong. And also you may accept when you are right sometimes. Yeah, that is. You accept, mainly to accept when you are wrong. Because sometimes you may be forcing things. You have made your own count. Maybe you are sure that, I had maybe this one as an ABC, but you find that market is still going down. Don't stick into an ABC and then keep on extending maybe stop loss there. You have to accept that if the market exceeds a certain level, my ABC is no longer correct. That's what we call accepting the analysis, and especially accepting when you are wrong. That's the case. And another thing is, you have to use the stop loss now. I said the extending stop losses and other things. So the fourth thing now will be use the stop loss. Use the stop loss. It's very important. It's very important. If you need to be profitable with the Weber principle, not only being able to count those waves perfectly. No, you have to add things like using stop loss. This is a protective thing, a protective tool in the market. Without a stop loss, I'm sure people wouldn't be successful in the market because of things like greeds and other things, fear, there are things like that, emotions, without a stop loss. Actually, emotions were the only thing to drive your trades, and actually you will end in a bad story. If you just involve emotions in your trades, you will end in a bad story, or a story with a bad ending. And also consider things like alternative counts. I've said there, the idea of alternative counts. I'm sure everybody now knows what is alternative counts. So you have to consider now. Consider alternative. Now, this we call it as an alternative counts. Consider alternative counts. Now I don't have many explanations to explain about what is an alternative count, how things goes. You can have now alternative count is all when you have more than one interpretation of the market structure. That's what we call alternative count. You have more than one interpretation of the market structure. That is an alternative count. So you have to consider those things. So things goes on, whereby another tip. We are looking on tips. Those are very important things. You can read on books. There are certain books, sometimes they explain about those tips. Okay. So now another tip is you have to use to make a count, but in conjunction with the Fibonacci. When it comes to this, we call it a Fibonacci tool. You have to use what we call a Fibonacci tool. This is very key. Having a perfect count without the Fibonacci tools, actually sometimes the market may stress you. It may not kill you, but it may stress you. Maybe you put and now you enter into the market, you will find that you have an airy entry. So having an airy entry, there will be a bigger pullback, so it is going to stress you for some time, and then after reaching a particular Fibonacci level, the market will start to go in your direction. So in order to enter at a perfect turn, in order to enter at a perfect turning point, you have to use a Fibonacci tool. I think I have a presentation there on the Fibonacci extension. I have Fibonacci correction that everybody knows. Then I have a projection that includes extension and expansion. I have a video that is very deep on the Fibonacci tool. Most people, they talk about the retracement, Fibonacci and other things, but that presentation on the Fibonacci is beyond. So go and look, watch that video, go and watch and see how Fibonacci works. And also consider potential entry trade in multiple time frames. You have to use multiple. That's a very important thing also. Because people may say that, I'm using the Weibull principle, so there's no need to switch from one time frame and another. No, you have to do that. Those are the key things. Multiple time frames. Multiple. We have this called the multiple time frames. Time frames. Always they are key. Whether you are using a price action, a pure price action, or anything else, actually multiple time frames place there. Now, why multiple time frame here is key? Because when you are watching a market structure in higher time frames, when you are watching in higher time frame, actually you make a count. What you will be just seeing there, mainly the clearly structure will be from those higher degrees. You will see those higher degrees very clearly. So those lower degrees, they will be not clearly visible. So switching from higher to lower time frames, now it will create a possibility of going deeper or specific in that particular structure. So as you go in lower time frames, you will be able to depict, those smaller moves. Example, you can have something like this. Market is moving like this, 1, 2, 3, 4, 5 is going like this. So in higher time frame, you will only see this 1, 2, 3, 4, 5. But as you go deeper in the lower time frames, you will find that this one shows the 1, 2, 3, 4, 5 again. Then this has got maybe an ABC or anything else, 1, 2, 3, 4, 5 again. So as you go deeper again, as you go deeper again in lower time frames, you will also be able to see, example, in this first move in red, it is also constituted of the 1, 2, 3, 4, 5 again. So switching to lower time frame, you will be able to see those, we call them as minor changes, those smaller changes. Higher time frames, it shows you bigger changes, and lower time frames, they show you those smaller or minor changes. So it's something like that. So we carry on other things. You have to remember a time frame that you are trading in. a time frame that you are trading in, you have to stick at in a certain time frame. It depends on which type of trader you are. So you can stick, maybe if you are a day trader, you can stick within 4 hours and H1 maybe, or mainly you stick in 1 hour. So this depends on your on type of trader, which type of trader are you, and also it depends even on the capital. On the capital, if you need to risk very small amount of money, you have to go to lower time frames. But if you have ability to sustain big losses, so I mean you have enough capital, not sustaining big losses, but you have enough capital to tolerate those bigger pullbacks, so you can trade even in 4 hours or anything else. So remember the issues on time you are trading in. Remember the time you are trading in. And another thing that is very important is to gauge with what to call the current sentiment. Another thing very important, sentiment. This is very key, sentiment. So yeah, it is true that you can make your own counts, and then counts may take you into a specific direction of the market. But sometimes you can make counts and make a decision of going in the market while the sentiment is against your account. So now, why you need to see the sentiment, and what is sentiment again? Now, the sentiment is all about the direction at which most traders, the direction at which traders are committed now. The direction at which traders are committed. So they may commit into sell or commit into buy. So what you're supposed to do is to follow the direction at which other traders are committed, because they will drive market to that particular direction. So now, if that's the case, so you have to use things like sentiment indicators. Do you see? You have to use things like sentiment indicators. Sentiment indicators, I will explain one day about indicators, and I will show you how sentiment indicators they are being programmed actually. How they are being programmed actually. So I will explain something about those sentiment or other types of indicators. So you have to use those indicators. Also, you may use things like COT. Do you see? We have those things like COT reports. You can watch COT reports maybe to understand what were the commitment of trader in a particular time, and in most cases you will find that those things correlate, or actually those things correlate with direction of market. If the commitment was in this way, you'll find that the market goes in that way. The last thing now, the 10th, is you must have a trading plan. Have a trading plan. Those are very important things. A trading plan. Now, I have a presentation on trading plan. I explained about a trading plan. What is trading plan? Those features of a trading plan. What are the constituents actually? A trading plan is constituted of what types of things? So I explained that idea. So you can watch the video on trading plan. So a trading plan, this is what to call something like a blueprint. Do you see? A blueprint. It means it is something that has got everything that you're supposed to do in a particular thing. So if trading plan is a blueprint of trading, so your trading plan must contain all of the important things that you're supposed to do when you are trading. That's what we call a blueprint. So a trading plan is a blueprint of trading. So it will constitute things like what are you are trading, maybe your trading strategy, what are your trading hours, your trading instruments, you are risky. Do you see? All of those are the constituents of a trading plan. Do you? A risky per trade, a lot size. Also, it includes things like mood, a mood before trading and a mood after trading. Also, they can be included in your trading plan. Maybe you can have things like, I will not trade if I'm in this type of mood, and also I will not trade maybe if I'm in this one. So that is a trading plan. It has got those things. It has constituted of many things, but I have already presented. And if you have any question about constructing or developing your own trading plan, you can write in the comment section there. You can write to have assistance on how to prepare your own trading plan. Without a trading plan, you will go nowhere. You will go nowhere. Even though you know how to count waves, you know how to play with the charts, but you don't have a plan, actually you will not reach anywhere. Those are the important things to know. So now this marks the end. So now this marks the end. this marks the end of advanced Elliott wave course. It has taken some time, It has taken some time to complete this. It has taken some time. 12 sessions, 12 long sessions. I have been preaching, the gospel of Elliott. I have been preaching the gospel of Elliott for a very, very long time. So this gospel must save you. This gospel must save you. You must be saved from those troubles in the market. Make sure that you make a follow-up. Repeat again watching those videos. Repeat, watch again and again. Write down summaries and other things from those presentations. Write down summaries and then go to the market and apply. Do you see? Go to the market, then apply those things. Play with those things that I have said, starting from the first session to the next until you reach the end session. So thank you for your time, and I wish you all the best. I wish you all the best in your trading journey. And this doesn't mean that this is an end of everything. No, we still have things. We still have things to teach, and you still have things to learn. So things will go on. We'll be dropping other things. Advanced Elliott 12, it doesn't mean that's the end of everything. So we'll still be dropping things. So you have to keep in touch. Subscribe to this channel. Subscribe, please. That's your fee. Subscribe, share, make comments and other things. So those are the key things. So thank you for your time. I've spent 45 minutes. 45 minutes is yes, enough actually. For those deep contents like this, 45 minutes are enough. Thank you. Welcome again.